If you're a crypto investor, particularly a new crypto investor, you're probably feeling a little bit tenderized at the moment. It's been a brutal couple of days in crypto markets. And so the natural question is, what should we do right now? Should we be buying more? Should we be selling? Hi everyone, I'm Paul, and in today's video we're going to be unpacking exactly what happened to Bitcoin over the last couple of days. As investors, it's really important to understand where the selling pressure has come from and why, and then use that information to dictate our investment decisions. So let's jump in. So one of the things we need to remember as crypto investors is cryptocurrencies aren't immune from some of the broader macro themes that are going on. So one of the big issues at the moment is inflation and what the Fed is going to do about it. And so what's happened in risk assets, and so when you talk about risk assets, we're talking about the stock market and other investment classes, is that they've reacted pretty poorly to some of the initial posturing from the Fed. And so if we look here at the stock market, you can see over the last couple of days, since the beginning of January really, the market just sold off really heavily. So the market's reacted quite poorly to that initial posturing from the Fed and has sold off accordingly. And that's going to continue until we see some decisive action from the Fed or some more concrete action from the Fed. So markets hate uncertainty, and at the moment there's uncertainty about what's going to happen, and so markets are selling off accordingly. Now, the cryptocurrency markets are pretty heavily correlated with equity markets now, and so it's not really a surprise then that we've sold off as well. So if we look at Bitcoin now in particular, you can see this is the daily chart, and you can see that after some of this initial sell-off, we found some pretty good support here around that sort of 41.7 mark down to 40.6. And so we've been trading around there now pretty much all of January. And now what the market in general is expecting, and certainly I put myself in that category as well, is that we were going to find a bottom somewhere around 40.6 here, which we did. And then you can see yesterday the market rallied up really quite strongly right up to 43,000, and a lot of people were calling the bottom in at that point. And certainly when I was watching the market, we were up about 4% or so at that point. It was looking pretty good. And you can see what happened is we hit this descending point of resistance here, and we just bounced straight off that, and then the market pretty much sold off in a straight line after that. There was a lot of things going on in the background. There was a lot of leverage traders who'd gone long and they got wiped out, and then the market just sold off. And as I said, it was pretty much a straight line. And if you look at it on a shorter time frame, you can really see how savage that sell-off was, and we just blasted straight through all these resistance points. Even sort of 39.6 was seen as a pretty strong resistance level, and we've just blasted through that, and that cascade has now continued right till today. And so at the moment we're finding support around this 36.5 mark, and if we zoom out a bit, you can see that there's support down here around that level. So if I just click that in now, you can see that. And so holding that 36.5 mark at the moment seems probable, but what we'll do is we'll unpack sort of how we got here, where that selling pressure has come, and try and use that to figure out what we think price might do in the next month or 2 months. So one of the things I really focus on is supply, and I think supply is one of the big factors driving Bitcoin price. And one of the first things I generally look at is the exchange reserve. So this is how many coins are sitting on exchanges and what that trend is happening. And the psychology behind that is generally if people have their coins on exchange or they're moving them onto exchange, they're doing that because they have the intention to sell on a shorter time frame. And so what we can see over time is that the balance of coins on exchange has just been dropping, and that's just a trend that hasn't really changed. And even though it might flex up and down a little bit as the price goes up and down, the general trend is very clearly to the downside. And so we have a very small number of coins that are available in circulation. So in previous videos where I've talked about the supply shock that is gradually building, is there's only about 20% of the total available coins in supply, the ones that have been mined so far, that are available in circulation. And so that very small amount of coins is generally sitting on exchanges. And another way of looking at this is the sum coin dollar age. And this is basically just the dollar value of coins that are sitting in wallets and have not been active. And you can just see that, the long-term investors, the hodlers, that this trend just continues. People just continuously accumulating, those coins sit in their wallets and they just don't come back onto exchange. And so, or they don't come onto exchange to be sold. And so you can see this trend just continues. If anything, it seems to be accelerating, and that is irrespective of price. You can see here, even as we this year hit the initial highs and then the all-time highs of about 69,000, that trend didn't change. And so this hodling behaviour just continues regardless of what happens with price. You can see it happened even during this dark period here in the middle of last year, where we had sort of like a mini bear market. That hodling behaviour didn't change. And so one of the things we can do is look at that sum coin age and the distribution. So look at the duration of holders and what their behaviour is. And so this is basically all investment horizons. So you can see sort of 10 years all the way down to under a day. And it's sort of a bit hard to see any big trends in here. But what you can see is that these long-term holders really dominate, up to about, about 2 years plus. These holders really dominate the total distribution of coins, and so their behaviour is quite important. Now, if we look at then some of these holders, these time horizons in isolation, it gives an even better picture of what's going on. So looking now just at the long-term holders, so this is everyone 12 months and over, all the way out to 10 years. You can see that, this is zoomed into a year. You can see these 10 years plus, just if we go left to right, you can see they're accumulating, and then the same thing pretty much at each level. Interestingly, this layer here, this sort of 3 to 5, had a big increase here as the market came down, but then most of them, this one's reduced a little bit. This 2 to 3 years, you can see some of that's transferred over to this group of holders, but pretty much all these long-term holders have increased over time, and the most significant ones are obviously these very long-term holders. You can imagine if they've been in the market for that period of time, their sort of average coin cost would be much lower. Now, where it gets interesting is when we look at the short-term holders, so anyone under 12 months. So that's pretty much the whole year, if you want to look at it in that perspective. They've accumulated at some point over this year. And you can see as we sort of go left to right, they really have hugged the price as we've sort of come through this initial period at the beginning of the year. They've accumulated, and then once we reach the highs sort of towards the end of last year, especially from November, you can see they've then been reducing. So the size of their holdings has been decreasing. And so it's really this short-term holders, and this sort of coincides with then that theory about most of these investors have their coins sitting on exchange, and this is the liquid supply. This is what's available in the market to be traded, and so it's really these investors that are driving the market at the moment, because this is all the available supply. We know that the hodlers, those long-term investors, are just accumulating. They're not moving their holdings. They just buy them and pull them off exchange, and we see the net flows from exchange continuously, just coins being pulled off exchange. And so it's really these shorter term holders, they're driving a lot of the current price direction, and you can see that here, that they're the ones who are moving the most. And the thing that's driving their behaviour is that they are short term holders, so they've only been in the market, say, for 18 months or less, or 12 months or less. And you can see this is the short-term holder SOPR ratio. And so this is basically how profitable they are. And under this orange line is basically all of them selling coins at a loss. And you can see this is why they're active and they're selling in the marketplace, because they've been underwater pretty much the whole time they've been in the market. And so if you think about the psychology of that, there's this sort of underlying theme in crypto is that people are making lots of money, and there's people who have been sitting on, Bitcoin from 10,000, 20,000. And so there's this underlying theme of in crypto you make money and everyone's making lots of money. But these short-term holders are not making money. They've only been in the market a year or so, and pretty much since they've bought, they've been underwater the entire time. So, there was a short period at the beginning of last year, and then they went into profit. But obviously there's a big number of people who bought here who then immediately then went into loss again, and then the same thing again. And so there's, a high number of these investors in this 1 year time frame who are just not making any money. And so it's natural then that they just get despondent and then they then sell. And so this is the cohort of investors that's driving a lot of this short-term price suppression. Now, one of the other cohorts where we get a lot of short-term price impact is derivatives traders. Now, at the moment, there's been an interesting switch. We're seeing many more derivatives traders cash margins, so that's where they're using cash collateral against their leverage positions rather than using crypto coins against their positions. And the reason why that is if you have crypto against your positions and the market's falling, the value of your collateral is falling as your positions may be going against you, so you get this double hit. Now, we had a big flush out of leverage in the system on the sort of 4th and 5th of December last year, and that was mostly those coin margin traders getting cleaned out, and we haven't seen them come back into the market. So we now pretty much have just cash margin traders in the market, and so they're not quite as sensitive to the price of the underlying asset because it's only really their positions that are getting margined. They're not getting their collateral margin at the same time. So we can see that open interest is still quite high. It's tapered off a little bit, but it's still pretty high. And interestingly, over the last couple of days, the volume has really gone up considerably. So we know that there's greater participation from derivatives traders, and that's gone up considerably. And it's not really a surprise when you start to get to these big pullbacks. You're going to see people come in because they're going to start speculating on the current price, which makes sense. Now, what's happened, you've seen mostly people come in and they're trying to buy the dip. So derivatives traders are speculating, they see the price come back. We talked about most market participants were expecting, around this sort of 40,000 mark, whether it was a bit above that or a bit below that, that would be the bottom. And cryptocurrencies, people are conditioned to buy the dip, it always comes back. And so that's what's happened. You've had these leverage traders come into the market at these key levels, they've levered up going long, and you can see as then the market pulled back, and lots of people argue about whether this gets orchestrated or not. We had this big run up to 43,000, and obviously these traders would have been getting levered up, or would have been getting set on the way up, and the market's pulled back and they've just got cleaned out. And so you can see this big spike of liquidations as all those long trades get cleaned out. You can imagine that then just creates this cascade. The market was sort of going up, hit that 43 mark. Maybe we had a bit of selling. There was too much leverage. Those long traders start getting liquidated, and that just creates that cascade that we saw in those earlier charts. You can see there was a little bit of liquidation of shorts, but nowhere near as much as what we saw on those longs on the long side. And so that's not really a surprise. Generally, leverage traders have this inherent ability to get it wrong, and so if we had a lot of traders coming in taking those long positions at this key point, it failed, and then we get that cascade. In this case, we get a long squeeze and we get that big flush downwards, which is exactly what we've seen. We really haven't seen a lot of short trading, although we did have a flip in the funding rate for a short period, which was indicative that traders were getting short, but it flipped back long again, and so we have traders just going back to the long side. And you can see that in the funding rate here. So you can see, we had that short pullback in the funding rate, which indicated that leveraged traders were going short, but that came back, which indicated people coming back to the long side again, as there was that thought that we'd hit the bottom and we were going to rebound upwards. And then, as we discussed, with price coming down, we had this long squeeze and then a push down on price. And so if we come back to our monthly chart now and we put together all of that information, so we know that we have short-term holders who are underwater, and so they are obviously with any push down the market. They're just panicking and selling. We have derivative traders who have seen this short-term opportunity to potentially trade the bounce, and that hasn't eventuated. They've got squeezed out. We've had a long squeeze and then a cascade down in price. And so this has all happened under the backdrop of, a broader macroeconomic theme of inflation and what the Federal Reserve is going to do in response of that. If we look at our monthly chart, what we can see is that long-term bullish trend is still intact because we haven't created a lower low here. We're still above the previous low. So that's intact. That's one small positive in a fairly dour backdrop. If we zoom into the weekly chart, we can see this angle resistance is still in play. And we can see this support level here at about 36.5 is where we've sort of currently stalled. And so the question will be, is can we hold that? And if we don't, the next sort of support levels are down here into this sort of 29 range. Now, that's a pretty dramatic drop to go down into that level. And so given the fall that we've had already and certainly the suddenness of this drop, that seems a bit unlikely. So sticking with the weekly chart, one of the things I wanted to focus on a little bit more is the volume. Now, the interesting thing that's happened over the last year has been a significant decrease in demand. The nature of the rally that we had back here, you can see it's quite clean. Most of the direction is up. There's not like that many long wicks, and it was quite a strong rally upwards. Now, if you look at then the rally that we had towards the end of the year leading up to the all-time highs, it wasn't as clean. It wasn't as neat as this one. You've got a lot more wicks. There's a bit more sort of up and down. And the other thing that's interesting about it too is this rally happened on increasing volume. So you can see this volume was increasing. We had pretty good volume all the way through these highs here, but we didn't have that in the second rally. So we had this big spike of volume here on these capitulation candles, but pretty much since then the volume has been low. And so that makes, in hindsight, this rally here up to all-time highs pretty suspicious. And so the problem we have is that we have talked about that we only have a small amount of supply, like 20% of the total available coins in the market, and this building supply shock issue. But that also works the other way when you don't have any new demand. So there hasn't really been new investors coming into the marketplace. We know that existing investors just continue to accumulate and they hold their coins in wallets. They're not on exchange, but we have newer investors who've only been in the market 18 months or so holding their coins on exchange. They're underwater, they're getting out. And then we have leverage traders also coming in, taking these positions on a short-term basis. And so the volumes just haven't been there. And that's one of the big reasons that I think we've had trouble maintaining any sort of upward thrust, is that every time this sort of small amount of holders who are here available to come in and keep accumulating, every time they come and buy the dip, they just get taken out again because there's just no other support. There's no new investors coming in to accumulate. And anyone who sort of was new over the last year is pretty despondent because their investments are underwater. So they don't want to sell, they don't want to buy more, I should say. They're just looking to get out. So anytime there's a little bit of a rally, they just get out. And so what we kind of have is almost like exhaustion at the moment. There's no new buyers coming in. Any buyers that have been in less than a year have no interest in buying. And so there's just no one to soak up any of that liquid supply that we have in the market. And so what does that mean for right now? Well, if we look at the daily chart, you can see we still have this resistance in place, and that's not going away, I think, anytime soon. And we've blasted through these resistance levels, at 39.6, and we're down now about 36.5. And so I think this is a key resistance or support level, I should say, that we need to hold. And if we go below that, we're really down into this 29 mark, and that is really, I guess, technically damaging to the market on the medium to longer term, because it is going to take time if we go down into this zone to work through that. You can see here back in the middle of last year, that took a couple of months to clean out. And so if we were to shoot down into here, I think it would happen probably fairly quickly. So as investors, we need to be prepared for that eventuality. And if it does, then we're going to grind, down in this zone here. And the further down we go, the longer that grind is going to be. So if we stay in this zone here, I think we'll grind, maybe only until sort of mid to end of February. But if we go down to this lower support line here at 29, then this could go right into sort of March or April before we sort of build up enough, or we shake out enough of these investors to then have the potential to move to the upside again. And so that would need to see us move across here before we could potentially come through and break through this downward resistance, and then the same thing here. But the further down we go, the further across we're going to need to grind out, I think, before we see any sort of upwards momentum. So in terms of my position, I'm not feeling particularly worried at the moment. This has obviously been a pretty awful ride all the way down here, and there may be more to come. And so I think it's important to be prepared for that. And in terms of what I'm doing, I haven't actually sold anything. I'd sold a couple of positions out here that were in profit just because I had a feeling that we would have some more downside, and I knew that those positions would get vacuumed down with everything else. But other than that, my core portfolio hasn't really shifted. I haven't added anything at the moment, but I certainly haven't sold anything. Now, in terms of what I would do in the future, I would want to see some kind of bottom forming before I'd start to do any more dollar cost averaging. And certainly if we push down into this zone, that same thesis would apply, as I would want to see some stabilization in a trading range before I'd be feeling confident to accumulate again. And obviously once you go into a trading range, if you get a trading range between these zones or between these zones, you really want to be accumulating at the lower end of that trading range. So there could be a potential short-term trading opportunity at the top, and if you're buying at the top, you need to have the understanding that you may go back to the bottom of the trading range. You may not necessarily go through that trading range up into a higher level. So I think regardless is the bottoming may have started here. We may be starting to see the start of a bottoming pattern starting to form here. You can see we've had these really big capitulation bars, and that's pretty consistent with the sort of final flush out. And we're now sort of garnering support now at this sort of 36.5 mark, and that could hold. And so if that did, that would be great. But I think just given what we've seen with price recently, and we know that there's no sort of new demand in the marketplace, it is quite possible that if we have any more selling pressure comes into the market, we could push through that. And I think if we push through that, we will have another flush. And so we have to be prepared for that eventuality. So that's what I'm doing. I'm not selling. I'm not really buying either at the moment, but my bias is towards looking to buy. So I'm just looking for some stabilization and some sort of confirmation that we've found a bottom before I would start averaging some of my positions, because my long-term views haven't really changed. All that's changed is the shorter term price. And for people who still have that longer term view, this is obviously a buying opportunity, and that's how I think you should be looking at it as an investor. If your investment thesis hasn't changed, the only thing that has changed is price. And so one of the things I'll be looking for as, I guess, a trigger for me in terms of anticipating that the bottom is in, is looking again at the funding rate. And so what I would want to see is a consistent period where the funding rate has flipped negative. Now, this could persist for a period, like you can see in mid last year where the market was in sort of this sort of bearish phase. We had the funding rate negative for a period of time. And, it took a while for that to shake out, but that was a good signal that the market had bottomed. And we have then derivatives traders going short because this funding rate is then paying the long position holders for the privilege of going short. We would want to see that for an extended period, because generally And as we saw just recently with the current behaviour, we had derivatives traders going long, the market went against them. Same thing. We want to see derivatives traders increasingly going short, because that's probably a good signal that the market is bottomed and it's going to go against them at some point. And we also get that supercharging of a short squeeze and then a rally, a short covering rally on the basis of those leveraged short traders getting squeezed out. So that's one of the things I'll be looking for to signify a bottom's in, and then to start accumulating on that basis. And so I think one of the things that's valuable at these times, and it's obviously these times when the market's against you, that you start to question, what you're doing and why you're there. And so if you're sitting in your office or at your screen or on your phone and you're feeling a bit nervous at the moment, you really need to ask yourself why that is. You need to look at your own behaviour. And so if you're sitting there and you're watching your screen constantly, looking at prices on your phone or on your computer, and the current price action, this 2 days has been like a 20% drop, if that's, caused you a lot of stress and you can't sleep and you have trouble eating and, just doing your normal day-to-day activities, then these are all red flags, and this is a sign that you've probably got too much exposure in the market, and especially if your investments are creating additional financial pressure in your life, like you have to pay other bills and you've sort of put too much money into crypto or even stocks, and you're like, I don't know how I'm going to pay my bills, then they're all really strong red flags that you've got too much exposure in the market. If you have too much exposure and you've got too much stress, you just can't make good decisions because you can't distance yourself from your investments. And so that's the position I like to be in, is that, we have a pretty reasonable amount of money in crypto and other assets. And obviously the market has pulled back across all those asset classes, but I'm not really stressed about it. I've got a really long-term view, and I can sit back, do some of these analyses and be detached from it and be more objective about it. And that's really how you have to be to make good decisions. And so you don't want to be feeling stressed, because obviously this is when people generally sell, is when they're at their most stressed. They just can't really make objective decisions, and they end up selling, and they look back at it in maybe 1, 2, 3, 6 months, and they really regret it because they've left so much money on the table. It's not to say they shouldn't sell at some point, because if you're obviously overexposed, you need to reduce your exposure to get to a point of comfort, but you don't want to be doing it at the worst point in the market. And you can clearly see at the moment we're at a really bad point in the market, and so doing anything, buying or selling at this point, you really need to know what you're doing. And so the thing that drives me ultimately is my investment thesis, and has that changed? And so I have a very clear view on Bitcoin and cryptocurrencies in particular, is that I think that they are going to be an integral part of everything we do going future, in terms of the web, and being a fundamental part of everything we do, just like phones and the internet has been over the last 10 years, or mobile phones have been over the last 10 years. And so that hasn't changed, and there's a fundamental supply shock that underlies my investment thesis, is that I know that there's a finite supply of coins available. There's only going to be 21 million, probably a little bit less, and there's about 19 million of those that are available in circulation at the moment, and it's estimated that about 20% of those are completely lost and will never be recovered. And in terms of, if you take out then what investors are holding and have no intention of releasing, that's only about 20% left. And so if you extrapolate that out, there's only about 2 million coins left to be mined. That's not a lot of available supply. And so it's very conceivable, in my mind anyway, is that the value of Bitcoin could go up very dramatically over the next sort of, 2, 3, 5, 10 years. And so I want to be a part of that, and that's why I'm investing, and I'll continue to accumulate over a longer time frame. So if you look at that view, my investment thesis hasn't changed. There's nothing that's fundamentally changed in terms of that macro view to change that. And so the only thing that's changed is price. And so price has come down, and so then I just need to reevaluate my investment decisions. So should I be accumulating? Should I be reducing my exposure? they're the decisions I make in reference to price. And so I think the other thing that's really important is just to remember that, crypto is still a relatively new asset class. It has been around obviously over 10 years, but most of the participants in the market are still sort of retail investors. There isn't a lot of institutional participation, and so you are going to get a lot of this extreme volatility. And again, having a limited supply, and at the moment we have an issue with demand, is you are going to get these really nasty whipsaws in price. And so that should be expected. And so when we look at our investment, we need to understand that we're going to have these periods where price can move a lot. It's not been unusual for crypto or for Bitcoin in particular to have 40, 60, 80% drawdowns from tops. And so that's what we're seeing now. So it shouldn't be a surprise that it's happened, and it will probably happen again. And so to summarize all of that, that was probably a lot of information. And hopefully you're not more confused now than you were at the start. But I think the thing to remember is that there's some broader macro themes at play. And, crypto is not detached from that. We are going to be affected by that as crypto investors, regardless of what we think. And we know that there's correlation with other risk assets like the stock market. And so with all of those assets reacting to this discussion around what's going to happen with inflation and how the Fed's going to react to that, we're going to be pulled into any of those sort of broader moves. So that should be expected, and that's just going to happen in the future as well. So we know from our analysis that it's the short-term investors, those investors that have been in the market for under 18 months, and they're the ones who are moving. And we know that they've been underwater pretty much the whole time they've been in the market. And so it's not a surprise that some of the selling pressure is coming from those investors. We also know that there's leverage in the market. We know that there was an increase in volume, and we had a lot of leverage traders trying to play the long side and got caught out. So the market pushed up to 43,000 and then immediately vacuumed down. We had a significant reversal of about sort of 20% from that level, and that created a long squeeze. All those leverage players got flushed out, and that sort of created this cascade. So we had a lot of those short-term leverage players trying to buy the dip, and they got caught out, and that created that sort of really strong downward pressure on price. So behind all of that short-term participation or activity by those players, which is created all this downward pressure on price, we still have on the long to medium term time horizon the supply shock in place. So that's not changed, and any analysis I've done doesn't indicate that supply issue is going to change. And as I've said in the video before, we know about 20% of the total available supply is in circulation. Everything's either lost or locked down. And so there's only really that small amount of liquidity that's available to be purchased. Now, that's a great longer term situation for investors in Bitcoin, but it's an issue on the short term because we haven't had any new demand come into the market for about a year. We saw that the sort of first rally up to all-time highs was done on the back of good volume, but the second rally up to all-time highs up to that 69,000 mark was done on pretty much no volume. And so that sort of indicates that we've had no new participants come into the market. Most of that momentum was all created off existing holders, and as we discussed earlier, a lot of those new investors that have come into the market didn't participate in that upside and have pretty much been selling at a loss through that whole period. And so there's been no new investors coming in to continue that thrust upwards. And so I don't think that we're going to see a V-shaped recovery at the moment. We went through some of the price scenarios. I think we're going to stay at this sort of 36.5 mark. But if that doesn't hold, we will go down, probably down to that sort of 28, 29 mark. And, depending on which level we stabilise at, we'll grind to the side for a period before we start seeing some kind of recovery. So my expectation is, at the best case, that's probably going to be another month. At worst case, it could be till the end of the quarter. So if we go, as I mentioned before, the further down we drop, the longer that grind to the side is going to be. So I don't think that drop all the way down to sort of, that sort of 29.2 mark is the most likely, but it's possible. And so we need to be prepared for that. And so in terms of what I'm doing, I'm not selling, I'm looking to accumulate, but I won't start accumulating until I feel more confident that a bottom has started to form. And so I think the thing about that is that you shouldn't be rushing necessarily to start accumulating if you have that mindset like I do, that this could be a buying opportunity that will be maybe not seen again for a very long period of time. So I don't think there's any particular rush. I don't think that there is a strong risk of a V-shaped recovery. I do think we'll grind to the side, and I'd want to see more indicators that a bottom's forming before I charge in and put any more of my capital into the market. So there you have it. I hope that was helpful. It's obviously a stressful time, and so if you're in that situation where you aren't sure what to do and you're feeling a bit stressed, hopefully some of those points were helpful to you and that they help you, make some decisions about your investment. If you've enjoyed this video, it would be great if you could like it. That helps other people to find it. And if you enjoy this content, it'd be great if you could subscribe. And I'll see you in the next video.